Hello everyone, how are you all doing out there? In today's news update, I'm going to cover off on owners exploiting a seller's market, market share of first home buyers up 50%, the high-end market is now also surging, the big banks are expecting a lengthy property boom, and interest rates are to stay low until 2024, so stay tuned. Hello lovely people, I'm Kate Hill, and as always I am here to give you the best commentary and content on our property markets, along with some really fantastic hints and tips. So just really quickly before we get started, if you are interested specifically in what is going on in some of our city property markets like Sydney, Melbourne, some of the regional markets as well, then go to our channel where you will find content on everything property related in those markets. Okay, getting straight into it. With buyers outnumbering sellers and prices rising, an increasing number of homeowners are planning to put properties on the market. Research commissioned by Westpac surveyed over 2,000 Australian homeowners and found that 35% of those homeowners want to sell in the next 5 years, with 12% already in the process of listing or planning to do so this year. Westpac's senior economist says that it's absolutely a seller's market at the moment. Sales have seen a big lift over the last 4 months and are up over 36% on a year ago, resulting in significant tightening in supply, with listings across the major capitals now at a 12-year low. Most homeowners plan upgrades before selling, spending an average of $32,000 on projects such as minor repairs, fresh paint, carpet or kitchen upgrades. The managing director of mortgages at Westpac has said that property aspirations have shifted in the last 12 months. 1 in 5 homeowners are selling for reasons relating to the pandemic, such as working from home and seeking more space. Now, much of the demand that has allowed property markets to defy the 2020 doomsday predictions has been driven by first home buyers. We are seeing this out there every day as we compete with them when buying property for our clients. The Real Estate Institute of Australia has said that first home buyers increased their market share 50% over 2020, motivated by the high level of government incentives on offer. I think it's actually to do with a lot more than that, but there you go. Now, of course, the surge in prices could impact housing affordability unless measures to improve supply are implemented. We really just need our stock inventory and stock levels to increase. People need to feel confident when they sell their home or their investment property. In some states, there are still emergency tenancy regulations in place, for example, that are restricting investors being able to sell their property with a vacant possession. So they can't market that property to a homeowner. And that's just one example of how stock levels in some states are being affected and why. The proportion of income required to meet loan repayments has increased to 34.8%, which is up 0.9 percentage points. New South Wales is the least affordable state, not surprisingly, with 44.6% of income required to meet loan repayments. The Northern Territory is the most affordable, with the proportion of income required to meet loan repayments at 21.9%. CoreLogic has said that the pace of growth at the high end of the market is a striking feature of the latest price data. The high end is the top 25% of property values and refers to dwellings at around $960,000 or higher for the combined capitals. In February, the top 25% in the combined capital cities rose 2.7%, led of course by growth in Sydney, then Melbourne, Brisbane and Canberra. This was up from an increase of 0.5% in January, CoreLogic said. The high end of the market clearly led growth in values over the month. The middle 50% of dwelling values increased by 1.5% and the low end of property values increased 1.2%. The uplift at the top end follows a deeper downturn during the height of COVID restrictions. In 2020, the top tier had a peak to trough decline of 4.3%. The low end of the market in the capital cities covers dwelling values sitting under 500,000. Now, the resilience at this low end during the downswing tends to be a common cyclical pattern. Now, ANZ's CEO has said that the housing boom could go on for quite a while, given the high demand and the easing of securing credit. House prices grew nationally, as we know and we've reported, an average of 2.1% in February. And economists are predicting that house prices nationally will rise 16% in the next 2 years. CBA predicts prices will lift 9% in 2021 and 7% in 2022, given that several markets nationally, including Canberra, Hobart, Darwin, regional New South Wales, regional Tasmania, and regional South Australia are currently growing at an annual rate well above 10%, these forecasts may actually be conservative. They are saying that the question of whether the boom is healthy depends, of course, on where you're sitting in the market. If you're an owner who is selling, it probably feels pretty healthy. If you are trying to get into the market, it probably doesn't feel quite so healthy. Now, this comes as news breaks this week that Australia's unemployment rate fell to 5.8% in February, which is down from 6.3%. Economists said that it was a surprisingly large fall and provided evidence that the labour market was improving much faster than people were expecting. An extra 88,700 people found jobs last month, which is pushing the number of Australians with jobs above the 13 million mark for the first time in 11 months. Total employment is now just 1,800 below pre-pandemic levels in seasonally adjusted figures. A Commonwealth Bank economist said that the surge in employment in February was well above the consensus estimate of 30,000. The jobs lost in the early months of the coronavirus pandemic have now been fully replaced. The next test, of course, for the labour market will be the expiry of JobKeeper this month. Now, on that note, following on a little bit from that, the Reserve Bank Governor Philip Lowe has said that there is no prospect of a rapid bounce back in wages growth. So Australia's interest rates are likely to stay low until at least 2024. Philip Lowe said that the point he wanted to emphasise is that for inflation to be sustainably within the 2 to 3% target range, wages growth needs to be materially higher than it is currently. The evidence strongly suggests that this will not occur quickly and that it will require a tight labour market to be sustained for some time. Predicting how long it will take is, of course, inherently difficult, so that there is room for a lot of different views here. Mr. Lowe noted that wages growth in Australia was now at 1.4%, which is the lowest rate on record. He said that wages growth was in a prolonged slump before COVID-19, and then the pandemic resulted in a further step down. He also said he was encouraged by a positive run of data on economic growth and unemployment, like we've just reported. The latest national accounts released this month showed that the economy grew by 3.1% in the December quarter as the domestic recovery from the pandemic-induced shock consolidated. But he said the solid numbers do not negate the fact that there is still a long way to go and that the Australian economy is operating well short of full capacity. So, of course, we will keep you posted on all things property from around Australia and how the year progresses. Giving you, as always, the best commentary and content here on our channel. So let me give you that end of video beg. Please subscribe to the channel. Click the little notification bell below. If you're enjoying all the free content, then please also hit the like button. I really appreciate it. And I will see you really soon. Bye.